Last week, we talked about the cash flow statement, and that was really just an idea of getting an understanding of where your money went, like from one year to the next, where did your cash go? This thing here tonight, though, is more of a idea of predicting. It's a looking forward as opposed to looking back and saying, what happened to all our money? This is a proactive type of approach that you can use. Any small business can use, any small business person use, anyone who's involved in the idea of, geez, I got to pay the bills and I want to know, will I need to get a loan or will I need money at some point in time in order to get those bills paid? And other times, will I have so much money that I'll have an ability to pay off the bills? So this is very much what we call a cash flow forecast. And if you understand the concept of it, it's pretty straightforward, okay? Pretty straightforward and a useful tool for running any business operation. So cash is king. What we mean by cash flow is not how much money you're making. It has nothing to do with how much money you're making. It has to do with when does it come in and when does it flow out. It's a timing issue. It's that proverbial bathtub that's filling up with water. The water's coming in on one end and draining out on the other. The thing is, you want water in the tub at all times. That's the idea, is you want to have more coming in than going out. So if you get a bill come, you got to be able to pay it, or you got to be able to, within a reasonable time, it got to be paid. So cash flow is king. And what kills a lot of businesses is cash flow problems. In other words, they don't have enough money coming in to pay their bills. In other words, they got more going out than coming in. And that's not sustainable in the long term. So we need to be able to kind of forecast for that, predict when money's going to come in, predict when money's going to go out. And that way we can make a plan so that we can always throw in a bucket of water in the tub if necessary, or be able to use something to catch water as it's coming out. So cash flow is critical. Business managers and owners have a bunch of tools. This is one of them we're looking at tonight. Just one simple tool. So the cash flow statement is a tool. The cash flow projection is another tool. As I say, cash flow statement that we looked at last week is for looking back in time and saying, oh, geez, we shouldn't do that again, or we should do that more. Okay, so it's an after the fact tool. This tool is for casting yourself forward and say, okay, we can make this succeed. So you want to be able to understand the basic concept of it. The first basic concept is we have to have the concept of a forecast. Let's think about when money is going to come into our business. So if you're operating a business, like let's go up in Labrador. If you're operating a hunting and fishing business, you're probably not going to be hunting this time of year. It's too cold. The animals aren't around. You'd freeze to death, that sort of thing. So you think about it, you're probably not going to have any customers in January, February, March, and April. However, come springtime, when things warm up and people are into it, May through to October, okay? May through to October, let's say, could be a good period for people who are interested in outdoor hunting activities or fishing activities, these sorts of things. So you think to yourself, the only time I'm going to be bringing money into that business are for that period of time from April through to October. All beyond the dead, from November till April, there'll be no money coming in because nobody's going to be using your services. So that's the first part of cash flow forecasting, is to think about when is money coming in and what times, and to be able to kind of plot it out a year ahead. So you're doing basically a monthly breakdown of, okay, this much is going to come in. And it might not even be dollars and cents that you're thinking about. You might think of percentage of the total year. So 100% would be the total year's income. 5% of it will come in April, 15% will come in May, 20% will come in June, 30% will come, and so on, right? So effectively, we just kind of plot out where is it we suspect our money is going to come in. We might also want to consider when our expenses occur. So we'll have to think about the same idea when our expenses go. Now, the thing is with expenses, generally you have what's called fixed expenses, meaning that you're going to have to pay your power bill all year, every month. Or your insurance bill is going to come in January, and that's when you need to pay it. Okay? Or other types of bills, you know when they're coming, and usually it's a specific time or a repeat type thing. So you can pretty well predict, and again, this is not guaranteed. This is a prediction of when money is going to come in, this prediction of your revenue, and when money is going to go out. So that's the real first thing you really need to think about before you ever start the mechanics of a cash flow forecast. The more accurate you can be in terms of your estimations of when money's coming and when money's going, the better off you'll be. So what you need to do is you need to create a spreadsheet. Now, just in case you're not familiar with spreadsheets are pretty straightforward. I call them pigeonholes, really. And what it is a thing that looks like this. This is what's called a spreadsheet. And you'll see that it's just a bunch of blocks. And it's a great big adding machine that works on this idea of pigeonholes. So you put information in each of the pigeonholes, have an address. Normally it's A, B, C, D, E columns, and 1, 2, 3, 4 rows. So column cell A1 is in column A, row number 1. A2 would be, A3 would be, A4 would be, and so on. So that's generally how we get it worked. And I'll show you the spreadsheet in a second. I just wanted to kind of get the idea to start with. Here's a real spreadsheet. So what we do is you can create a cash flow, and normally these templates are widely available online. They're widely available online I'm using Google Sheets here now, but you can use Excel or anything like that. And they all have these cash flow forecasts on them. And they all work exactly the same way. So if you're the least bit familiar with a spreadsheet, you can put numbers, words, or formulas in these cells. So in this particular instance, let's say, for example, that we are going to do a forecast, and instead of a monthly forecast, let's do a weekly forecast here. And you could do it daily. It doesn't matter. The time is, and all you're trying to do is really determine when you're going to need extra money. So in this particular instance, let's say, for example, let's do a very simple, let's assume you had a bank balance, you need a bank balance, an opening balance, let's say of $1,000. Let's assume you had $1,000 there in the bank. And you had cash receipts during that week. You expect $500 to come in receipts, and maybe someone's going to pay a bill from last week that they owe you. So let's say there's $250. So you're going to have total receipts of $750 come in. So there you got 500 plus the 250. You're predicting $750 will come in. You're also going to make payments in that week 1. Your taxes, let's assume you don't have to pay your taxes until week 5. You figured it out. Your taxes are not due until later on. Don't have to worry about that. You're going to have to pay someone $500 at the end of this week. You're not going to spend any money on sales and marketing. You're going to have the capital expenditures, like you're going to buy something that's going to require some cash. Let's assume you're going to spend another another $500 there. And that, let's assume that you're going to buy you're going to have to buy some cash purchases for something. I don't know what, but let's assume another $500. So basically, you've gone out now and predicted this week that you're going to have $750 come in. You're going to have $1,500 go out. You had $1,000 to start with. So at the end of the week, you're going to have $250 left in your bank account. Now, the good thing is you're going to say, well, my bank account is getting low, but on the other hand, it's not below zero, so you don't need to borrow anything. So this $250 closing balance for this week then will become the opening balance for the following week. So again, you can predict what's going on in that second week. You know, in the second week, for example, that you expect a customer who owes you a lot of money is going to come in and pay it. He said he's going to come in 2 weeks' time and pay it. So let's assume that you got $1,000 coming in there, and you might get $500 extra dollars in sales that you'll have come in. So you expect total receipts of $1,500. And you're going to end up paying payroll again the following week. You're not going to pay taxes. You're not going to pay any money in sales and marketing. You're not going to pay any money in capital expenditures. You're not going to pay any interest. You might make another $500 in cash purchases. So effectively, casting your mind ahead in terms of 2 weeks' time, you figure you'll have $1,500 come in. You'll end up putting $1,000 out. So you'll be $500 to the good. So you can imagine that you predict that you'll have $750 in your bank account at the end of the week, at the end of that second week. Now, the third week comes, and let's assume a similar situation. In the third week, you predict $1,000 will come in, and another $500 will come in other forms, so $1,500 in total. But let's assume you're going to have to pay your taxes, and your taxes are going to be $3,000. You know that you've acquired that much stuff. You're going to pay you'll pay your GST account that we talked about. And that's going to cost you $3,000. We know you're going to have to pay $500 in salaries because that's coming along every week. You're not going to do anything else, though. Basically, that's the only payments that you predict you're going to make in week 3. Well, having done that then, and, assuming that you're predicting ahead, you can imagine that you're going to have a problem in the third week because you're going to end up having to spend more money than you actually have. This means that you're going to need to, in 3 weeks' time, you're going to need some form of credit in order to be able to pay your bills for that week. So this process, you can repeat this process. And again, your prediction window or your ability to predict is only so far. And as it gets further away, it gets more and more iffy, we'll call it. So what you can do with the spreadsheet is you can change the number. So let's say, for example, my opening balance was $100,000 instead of $1,000. If I put in 1,000, the thing is with a spreadsheet, watch what happens when I press enter here. Everything updates because I have a formula built in here to adjust it. Now, if you were to get a template, which is basically formula is already done for you, this will be ready. And all you got to do is plug in your numbers just as I'm showing you here now. But effectively, you will be able to predict the future. That's effectively what you're doing here with regards to the amount of cash that you'll need at any given point in time. And it will also be able to predict how much money you're going to have in the bank at any given point in time. So it's a really good management tool, this cash forecasting, a really good management tool for small business to have to be able to make sure that they don't run out of cash or make sure that they know that they'll be able to pay the bills, the line of credit that they had to get last month because they didn't have enough money. They'll make sure they got enough money to pay the bills to cover off those expenses. These things, when they're filled out or when they're completed or, when you exercise them as I've done here, are very useful. So if we got, for example, a 13-week forecast for a business here, and I've got this one filled in with a bunch of numbers here, we know that there are certain weeks we're going to be in the red. We're going to be our bank account will be minus right here, right here, right here, right here, right here, right here. We're going to need a line of credit. Now, how much line of credit do we need? How much are we going to have to do to the bank? Well, our prediction shows that at its maximum, we're going to need, we're going to have a cash balance in the negative of just over $10,000. So when you go to the bank, you're going to have to say, look, I'm going to need a line of credit of $10,000 for sure, or $11,000 in this particular case. So it allows you to be able to go to your bank manager and say, considering my prediction of where I'm going to be or what I plan to be in the next few weeks or the next 13 weeks or the next 13 months or whatever the time frame you have, I'm going to need a line of credit. I'm going to need you to assess my credit for $10,000 or $11,000 in this particular instance, right? It'll probably be hundreds of thousands of dollars for a real business because, again, these numbers are artificially small, but the concept is identical regardless if you add more zeros or not. It doesn't really matter. You can use this tool in order to predict when you're going to need the money, how much you're going to need in total, and when you're going to be able to pay it off. So in this instance, for example, we know we'll be able to pay things off. We'll be doing pretty good in weeks 11, 12, and 13, meaning the business will start making money. We'll start having positive cash flow or start making more money than spending in these points. So if you got a business that's seasonal, such as a hunting business, for example, these are in this period here, you're not making any real amount of money, so you're probably going to be running in the negative. But all you need to be able to do is look a little bit further ahead and say, oh yeah, well, this problem will resolve itself in the future. Now, this is good for you, but it's also good for your banker, because if you can show your banker, look, here's what I plan. Here's my plan for carrying this forward. I expect that money will start coming in March and April and May and June. And if you can demonstrate that to your banker, the banker is going to be much more willing to loan money because you have shown that you have given it some thought of when dollars and cents are going to come into your business. And it is a helpful tool for, again, marketing your business to a banker, for example. So these cash flow statements, this is what it looks like when it's empty. These cash flow statements are exceptional. These cash flow projections are exceptionally useful as a management tool and exceptionally useful as a tool for you to consider when you're going to the bank to say, okay, this is how much money I need. So right here, I got another little example that I just want to demonstrate to you in terms of the use of a cash flow with some basic information. So let's assume that you have started a business and you have sat down and considered your expenses, considered when your money's going to come in, when your money's going to go out, how much is going to come in, how much is going to go out. So we're going to say, assume that the opening cash balance is $3,000, meaning that you put $3,000 into the bank account to get you started in the business. So at the beginning of your business. You're assuming cash receipts coming in, receipts of $3,000 a week for the first 4 weeks, rise to $5,000 a week for the remaining weeks of the forecast, and assume no other receipts. So again, to keep it simple. And that's a pretty easy prediction. It's not unreasonable for you to think, okay, well, I should be able to draw in about $3,000 a week, and then when the season starts, I should be able to bring it up to $5,000 a week. In terms of payments, when your tax payments are going to be due, for example, or when your weekly payroll is going to be due, or when your sales and marketing costs are probably going to happen. So that, again, is something that you should be able to predict. And you can assume major purchases. So let's just say you're going to buy a $5,000 item in week 1 and 3. And based on this analysis, then you're going to be able to learn some things. So what are the things we're looking for in this particular example? We're looking for how many weeks is the company going to need to draw on its line of credit. We're going to have to ask the question too, what kind of line of credit am I going to require? How big is it going to have to be? What's the maximum amount of money I'm going to need to borrow? And where are you going to be in week 14? Okay, so let's just take a look at these. So I'm going to take this out of your view now. I'm going to bring this over on my other screen, meaning that you won't be able to see it, but I can read it. And let's go to cash forecast. So I'm just going to now take this out of here. I'm going to clean this off, and I'm going to clean this off. Okay, so we'll start here with a blank slate. Now, it says here, oops, assume an opening balance of $3,000 and receipts of $3,000 a week for the first 4 weeks, and it rises to $5,000 in the remaining weeks. Okay. Okay, let me just bring it over there. So you're going to assume your opening balance is $3,000. So here we are putting it in there. That's our opening balance. And we're going to assume the cash receipts of $3,000 a week for the first 4 weeks. Okay, so cash receipts, I'm just going to put it here, 3,000. Okay, so, and 3,000. And 3,000. And 3,000. And it's going to rise to 5,000 in the remaining weeks. So I'm just going to pull that over now. Get that over to make it simple. So you need to play. I'm not demonstrating spreadsheets tonight as much as I could, but the basic concept of a spreadsheet is just a big adding machine. So we look at our cash receipts. This is the money that's coming in according to the setup. So 3,000 the first 4 weeks, and the remaining weeks is going to be 5,000. So you can see the total receipts coming in. In terms of payments, okay, I'll just bring this back in your view again. In terms of payments, we assume tax payments of $200 a week and a weekly payroll of $1,500 a week. Okay. So tax payments of $200 a week. Okay. Bring this across here. And assume $1,500 a week payroll. Take this across here. And assume sales and marketing costs of $2,000 for the first 3 weeks and no cost thereafter. Weeks. Yeah. Assume, and the next thing says, assume a $5,000 cash purchase in week 1 and 3. Okay, so cash purchases, week 1, 5,000. And week 3, 5,000. Okay, so that's it for our prediction in terms of revenues in and payments out. So we got to start here, and we started with we opened with a $3,000 balance. We brought 3,000 more in during the week. That's a total of 6,000, even though I don't have it added up here. We took money out. In this case, we took $8,700 out. 200, 1,500, 2,000, and 5,000 to 8,700. So that would mean that we ended up with 3,000 plus 3,000, which would be 6,000 minus 8,700 minus $2,700. Okay, so the very first week minus 2,700. That $2,700 negative closing balance will be the beginning balance for the following week. So I'm just going to put a little formula in there to make that do that, as opposed to writing it in. So that $2,700 in the hole is not very good. So we start week 2, $2,700 in the hole. We bring in $3,000. That brings us up to positive $300. Then we made the spendings of a total of $3,700. And that brought us down then in the negative. We ended up being $3,400 short. So we went from $2,700 in the hole to $3,400 in the hole in the next month. That $3,400 then becomes the amount for the following, that $3,400 in the hole becomes the beginning balance for this week. Then we have receipts come in this week of $3,000. That brings us up to $400. So effectively, we are having all these monies go out. Now we're $9,100 in the hole. Okay, we're we're spending more than we have coming in. But that $9,100, our spending is going to be cut a good bit now. So that $9,100 then goes to become our money coming in week 4. Now we're up to minus $7,800. $7,800 is the week 5. We have money coming in and money going out. We're getting better. We're coming up out of the hole. I'm just going to drag this across now. Effectively, the end of month becomes the beginning of the following month. That's effectively what happens. So what we're seeing here, we're predicting how deep a hole we're going to fall into. We started out with 2,700. Then we went down to 3,400 below. Then we went down to 9,100 below. We start pulling ourselves out of it. We're 7,800 below, 4,500 below, 1,200 below, 2,100 above, 5,400 above, 8,700 above, 12,000 above, 15,300 above. So it's not unusual for a company when they start to lose money. So the question is then, how much or on what weeks will the company need to draw its line of credit? That's the basic question. So we're going to have to draw down our line of credit this week, this week, this week, this week, this week, this week. So basically the first 6 weeks are going to require borrowing in order to pay the bills. We start running into what's called a positive cash flow situation. In other words, our closing balance is actually above 0 in week 7. And once we hit week 7, notice that we're actually above water, or in a positive. We're having more money come in than we have money going out. So at the end of week 4, or at the end of week 13, or the beginning of week 14, which is what will be the cash flow, we predict that we'll have almost $22,000 at our disposal. So in other words, that's great. We're we'll say to our banker, we're going to have a rough patch for the first 6 weeks, but then we predict that we'll actually start making money. So your banker is going to say, okay, that means I got to wait 6 weeks in order to get paid, number 1. And number 2 is you're going to have to say to your banker, look, on week 4, I'm going to have the dip as low as about $8,000, $7,800. So I'm going to need an $8,000 line of credit in order to cover off this worst case month. So you will have a lot of information that you can go to your banker with to say, okay, here's what the plan is for my business. Not only is the business going to be profitable, but it's going to make money. You can see, at the end, there's actually good money coming in. But in the meantime, in the first 6 weeks, I'm going to be in a negative situation. I'm going to need some help in order to keep my business alive there. And, that the bank will be able to, or some financer, being an investor or someone else, would help keep your business alive until it actually starts making money. But at least you'll know, and you'll have that light at the end of the tunnel by doing this forecast. And you might say, well, the forecast is not super accurate. That's not the point. The point is you have at least some sort of a plan that you can constantly update. As the information becomes available, you can always update this. So you can predict when your business is actually going to start making money, and so that you will be able to, contemplate the fact that this business can actually make money and you can benefit from it, and it's worthwhile pursuing. So it helps ensure that your business avoids cash shortages, especially if you know how much the shortage is going to be. You're going to have the shortage, but avoid the problems of cash shortages. That's what I should say. And when you're going to actually make money, helps businesses get out of debt faster, because you'll know, where you are and what you need to do. Maybe it's not a good idea to spend this money this week. Let's wait until 2 weeks' time when we have some money coming in, that sort of thing. Helps ensure your business will adhere to debt covenants that may be accountable for. Maybe, for example, the bank will say, well, we'll loan you money, but you got to pay us back within 2 weeks. So if you look at this and you say, oh, okay, I'm not going to be able to do it, get it done in 2 weeks. I need to do something different. I need to look for a different line of credit or do something else. And enables businesses to grow more predictably. And that's basically the key one, is it gives you a sense of what's going to happen in the future. And it's not guaranteeing that that's going to happen, but it gives you a better sense than blindly fiddling around in the dark. At the end of this particular activity, at this end of this module, I got a discussion activity number 4, which is to develop a cash flow statement. And it works on that same basic concept that I just showed there, and that's in the notes. It's pretty straightforward, but I want you to work out this concept because it's easy to look at and say, I understand that. But you need to kind of fiddle through that concept. So what this does is it has you go through a simple example.